Hey traders, Raghee here. Welcome to Charts and Coffee. Happy Tuesday, everyone. Hope everyone's having a good morning. We're already seeing some volatility on the morning. Let's take a quick peek at some of the broader averages and see what the NASDAQ, S&P, and Dow are up to this morning. If you take a look at what's going on the, let's take a look at the S&P. That's a really good combination of what's happening at the NAS and the Dow level, this being the sort of the combination of those two. And you'll notice right now, for the most part, I think the most notable thing as we transition from, say, the Asian session into the European session was that the 5-minute chart of the S&P has crossed back down and is still below the 200 propulsion. This is a combination of a fast and slow exponential moving average, the 8 and the 200. And as long as we're below that, there's a certain bearishness inherent to the sentiment. We jump on over to the NASDAQ. And by the way, just because the NAS might be heading down doesn't mean the Dow has to either. Yesterday, we saw by about mid-morning, 15 to 20 minutes after the bell, that the NAS was actually pushing to higher highs intraday while the Dow was pushing to lower lows. And this is possible. And obviously, we saw it yesterday because the composition of those two indices are so different, right? Tech, communications, consumer discretionary on the NASDAQ side, while on the Dow side, you've got financials, tech, and healthcare. And when you have completely different sort of cylinders running those motors, they can do different things. So I won't be surprised. But right now, it looks like everybody's on the same page. And that actually makes for easier trading, right? When everyone's on the same page, meaning the risk appetite in equities is pretty much the same across the Dow, S&P, NASDAQ, that does make for better follow through as opposed to the push pull that we saw yesterday. All right, so that is what's going on in the broader averages. Let's go ahead and jump on into the questions. We do have the simpler training room folks in the house, so good to see you all. Question coming from there. Apple. All right, so let's jump into our questions. And let's see here. Jumping into Apple. All right. The question is, I'm short with puts. All right. So time frame does matter, RPJ. I'm not sure what time frame your put position is based upon at the moment. That would matter, obviously, because time frame dictates time horizon, and oftentimes time frame will have a different market structure, market condition, right? But right now, if I'm looking at, and again, it depends on from where, right? What did you pay? When did you get in? But regardless, I'll tell you this much. I'm not allowed to get bearish on Apple. There might be opportunities to take advantage of movement lower. Obviously an uptrend does correct. And if you want to dial that into, say, a 1-hour chart here, obviously we can hit the yellow or golden zone of resistance on the DPMR. We can get down to the gray zone of the DPMR. Those are all possible, but the general direction of Apple is up. So the question is buying put something where you're trying to take advantage of a retracement? Because for me, in an uptrend, and again, this is just based on my tools. For me, based on an uptrend, I'm simply not allowed to be in a position that would expect extended periods of movement to the downside. In fact, what I'll be looking for is a pullback. So as far as a retracement goes, then I've got to wait for a resistance level like the daily price movement range to be hit, whether that be the 60-minute or the 1 hour. I need price to actually catch up with the gold zone up in this area, or whatever that color is. and at that point, I can look for movement to the downside. So I wish you luck on that position. I simply cannot put that trade on because I don't have a setup, right? So I've got to wait for that setup. And I do appreciate the question. All right, moving on to our group in the, let's see, YouTube. All right, KR asks, is there ever a time I don't put my option order in at the bid? Rarely, KR. So the question is, as far as routing our order flow, this is something that's become a bit of a sort of a lost art in a sea of market orders. I do not believe in using market orders. I was taught many, many years ago not to use them. They are a gateway drug to overtrading. And also, John tells a great story about why he was taught by the garden lady not to use market orders. So I don't I don't use them. However, the question is there a time where I may not put my order in at the bid? I could probably count on one hand per year the times that somehow or other I've screwed up, or there is a mistake. I mean, if I'm looking at a market order, there's some kind of mistake I've made in the planning process. I could probably count on one hand the times I'll use a market order in a year, if not two. That said, is there a time that I don't put my order in at the bid? Yeah, I'll split the bid and ask. We've talked about that a lot, KR. So if you know enough to know that I put my order in at the bid, you know that we also talk about splitting the spread in the bid and ask. And that would make me the inside bid, or frankly, the inside ask, depending on what it is I'm looking to do. So thanks for the question. All right, next up is, let's see, Aaron mentions all shorts cover market on a squeeze. Right, Aaron, and you make the point beautifully there. It's a panic order, right? It really, really is. Thanks for making my point poetically, Aaron. Yeah, that's awesome. That's awesome. All right, good morning. Good morning, Kelvin. What are my thoughts on Texas Instrument? All right, so let's see what the charts say. Texas Instrument is in a neutral environment. I'm going to start building this trade from the bottom up. Multi-trend is neutral. Then I move on to the next thing I'm going to look for. Are we overbought or oversold in the stochastic? We're coming off an oversold zone, hence the movement higher. If we're going to see another push, we need to make it through this midpoint on the slow stow. So there's a lower end at 20, there's a mid at 50, there's a high at 80. To get another boost of momentum, we need to make it through that 50%, make it through that midpoint. Then we've got the 200 overhead. So we are still generally bearish. We're in bearish territory on Texas Instrument. Now, I think of Texas Instrument and immediately I think of SMH. Immediately I think of NVDA, even of Taiwan Semi. And it's really interesting to see that Texas Instrument is a bit of a, if you think about the group that it would typically be hanging out with after school at the bus stop, right? What are the stocks that it is most weighted with? And, I've got to say, probably TXN's a bit of a laggard. There might be better places to look to the long side. However, some of you might remember about 2 weeks ago, I talked about the importance of a stock making it through that initial break higher through the 200 propulsion. And this would be about 172. I'd keep an eye on that, Kelvin, because if we run stops, and that's nothing insidious, that's just order fills, right? If we can run stops through about 172, we'll likely find some bullish Momo behind that move. All right. Next up from our training room, Earl asks, what are the implications of the recent relentless downdraft? Wow, very descriptive description. I'm clearly not firing on all cylinders yet in the verbose department. What do I think about this movement? Yeah, it is pretty relentless, isn't it, Earl? What are the implications? Earl, in the most basic sense, I like to go back to something we've probably heard from a lot of mentors if we've had them in our early years of trading. And that is, why is the market moving down? More selling pressure than buying support. Why is the market moving up? More buying demand than selling pressure. What's the implication of the ZB moving lower? Higher yields. And it doesn't surprise me. So now we go back to, obviously that's the most obvious, right? Thanks for the myopic analysis, Rog. But what then is behind that? When I take a look at the shorter end of the yield curve, when I take a look at the sort of the middle, if you will, the 10-year, so ZT, ZN, they're all moving lower. And this is despite a fractionally higher amount of hawkishness for June and July. Certainly not probable, just mildly possible in terms of what we're expecting for the Federal Reserve to do. We're not widely expecting a rate hike. We just know it's possible. Okay, so then why wouldn't yields go down, since clearly we are mapping towards that Fed pivot in November where rates are going to not only be paused by then, but start moving lower. We have this funny little thing called the debt ceiling in the meanwhile. And it does seem that as we're going through the concern and the uncertainty of this debt ceiling, the shorter end of the yield curve is going to be the most affected. You can see what happened in the 1-month government bond. Wham, it just went up in yields instantly. And we're probably seeing a lot of higher yields with that concern of the debt ceiling. And I would say that's a big part of that. Now, as far as what I want to do, look, we're still not at a point where I can set up a long trade. I'd like to get the combination of the daily price movement range, maybe some volume, an oversold stochastic, and a minor low. Is that asking for too much? But that's the sequence, right? Think about your trade setups as those features that you demand price reflect back to you before you put your money at risk, right? The more items in that sequence, right? The more things that you demand price action to do before you get in, obviously the more discerning the trade, and the longer you're going to wait for all those criteria to occur. But that's what I'm waiting for. A pretty lengthy list of criteria that must be met before I want to get long bonds, as long as they remain neutral, which for now they do. All right. So next up is what are my thoughts on EEM? All right. Take a look at EEM, Forex Trader. EEM. So this is really, as much as this is called the Emerging Index Fund, and you probably know this too, FX Trader, this is China. Most of the stocks weighted within this ETF are Chinese stocks. So I'm going to look at things like KWeb. I'm going to look at things like eWeb, and that's where I'll get an idea of what that EEM is likely to do. So when I look at EEM, KWeb, and eWeb, and I look at the 200, they're all overhead. That's going to continue to be an issue. However, the proximity that price action has, well, let me show you the last time. You might say, Rog, there is a difference. It's slight though, and it might still be a problem. But take a look at the last time we broke the 200 on April 11. We were already at an overbought stochastic. In a neutral environment, that's the ceiling. That's the overbought signal. This time, and frankly, I would have preferred if the slow stow was a little bit further back so that by the time we get to the 200, we're not already overbought. So that's the challenge you've got here. If we can get through the 200 without the overbought signal, we'll probably get the overbought signal around 40. But at that point, perhaps we've been able to get above and close for a few sessions north of that 200 propulsion. Kima. Shoti. Sorry, I only do this show every day for the last 3 years, and Mom doesn't seem to remember that one. All right. Yes, I'm giving her a hard time in Bangla. So if we take a look at EEM and we take a look at that resistance level, there's two of them. The question is, which one is going to be sitting with an overbought slow stow, and which one is going to be able to trigger without the slow stow overbought? Because you can see last time what happened. It was not a successful move to the upside. All right, moving on to Tesla. All right, can I please look at Tesla based on decoding volume? Sure, Praveen. So when I look at decoding volume, let's do it two ways. Let's start with the this year's volume profile. So I'm going to take a look at the point of control for the year, which is really pretty close, 194.87, 195. We got the daily price movement range sitting there. Yeah, a lot of resistance sitting at that level, but much like Amazon that I discussed, much like the EEM that we just discussed, getting above that 200 is a big deal, right? Getting above that 200 would find some bullish momentum. Until then, we don't really want to bet on that until we can find, and by the way, notice it's an overbought slow stochastic. So are the chances that we continue higher through that 200 high? They are not. This is overbought as we're nearing the point of control, as we're nearing the 200. So Tesla's going to need a lot of help. This is where news is going to be helpful. This is where an overall rising tide in the NASDAQ, the S&P, and more specifically consumer discretionary would be very helpful. So that is what I'd be focusing on there. All right. Let's see here. Next up is Jay Silvestri asked, dollar index, it's opposite-ish. Well, no, it is a negative correlation. Yeah, Jay Silvestri, it is a negative correlation to the euro. Is it a negative correlation to gold and silver? No, I would not go as far to say that the negative correlation, the inverse or opposite correlation is as steady in gold or silver, but it is absolutely a negative or opposite movement to the euro. You got it. Is it careening towards 945 inflation stuff? I have no idea what that means. But let's take a look at the DX. Jay, let's take a look at the DX. Let's start there. So we have resistance on the US dollar index futures sitting at that 200. If we're going to look at the DXY, which I will tell you, I usually don't look at the DXY, but you'll see it's the same view as the dollar index futures. So same idea. Overbought, neutral environment. The neutral environment was preceded by a downtrend, and that's where the resistance would be, whether it be DXY, whether it be the DX futures. And by the way, UUP is the ETF for the US dollar. Notice it doesn't look anything like those two, but UUP would be a really interesting look to the downside, while the FXE would give us an interesting setup to the long side. So those two are, by the way, on the This Week in the Markets newsletter, which you can check out, by the way, over at thisweekinthemarkets.com. And I talked about putting these two on the watch list today, euro to the long side, dollar to the downside. And yeah, I do like the resistance and that negative correlation or inverse correlation or opposite-ish. I love that, as you said there, Jay. All right, moving on to Matt. If gold is tied to real yield, which is the nominal yield of a bond minus the rate of inflation, oftentimes they'll use a 1-year or 2-year bond minus the rate of inflation. Is it still bullish if we see Fed fund futures start to price in more of a rate hike likelihood in June than it currently does? Well, if the bond yields are continuing to move higher, and if inflation remains flat, we'll get the PCE this Friday. That means the chasm between that increasing yield, likely on the debt ceiling concerns, and the flat PCE or CPI is creating a wider chasm. In other words, real yields are going up. That's where your problem is. That's where our problem is on gold. Real yields are actually fractionally ticking up, and that's why gold's moving a little bit lower. So if we see even more hawkishness, that would be bearish to gold. But we would have to be a little bit more convincingly. I believe that currently, let's take a look. I don't have to guess. If we take a look at the CME Fed Watch tool, love this. And there you go. The current expectations for June are 73%, and the current expectations for a June hold, 73%, for a June hike, 27%. For July, a June hold, and this is where it gets interesting. So June is not the month we're looking at a Fed hike, most likely. July is, Matt. And a summer hike is a funny thing. We'll see what happens. But 56%, almost 57% expectation for the hold, 37% expectation for the quarter point hike, and this nagging little 6% for a half point hike. Craziness, right? But I would add these two together, because the 37.2% column and the 6% column really are combined a hike column. So July is where it gets very interesting as far as whether or not the Federal Reserve hikes. Now, this Friday, we have the PCE. If we're going to see those expectations either heightened or sort of be unwound, it's going to be when we get the core PCE, when we get the core durable goods, we get that data, because the PCE is the Federal Reserve's pet inflation. That's what their models are predicated on, not the CPI, but the PCE. So we'll see where we are after 8:30 on Friday. All right. So thanks for the question, Matt. And just like that, gang, our show is wrapping up. Thank you so much for being a part of Charts and Coffee. Caffeinate and dominate, my friends. I will see you all tomorrow, same time, same station.